Hello, welcome to Take Note. Take Note is a series conceptualized by Asia Society India to provide explainers on global issues affecting India and South Asia. This edition today is titled Take Note on Tariffs and its Implications. So I welcome Wendy, Surjit, and Neelkanth to the first edition. Thank you for joining us. Let's get down to the topic. It's really hard to believe that the Trump administration has only been in power for less than 90 days, given how active the administration has been. Just in the run-up to this conversation today, I was looking up, as of yesterday, we've had 123 executive orders, and approximately 40% of that is directly related to trade and foreign policy. So, there's a lot going on, and today we are here to discuss tariffs, which actually has been rather arcane and somewhat misunderstood economic instrument for a long time. But clearly it has become of importance, and we all want to know from you what the implications of the recent moves are by the US administration. So, before I begin, I did want to mention that the Trump administration during its campaign, particularly President Trump, had mentioned the use of tariffs. In fact, the line "tariff is a beautiful word" was called during his campaign. And, little did we know, or little could we foresee how he's going to use it. And then on January 20, 2025, there was a speech on Capitol Hill where in a larger speech, but he mentioned something like God first, religion, love 3, and tariffs at number 4. So, but again, little did we know how he's going to use this instrument. So that's why we are here, and would love to know from all of you what to make of the situation we have now. Let me start with you, Wendy. How do you interpret the decisions that have come out of the White House? Particularly since the Trump administration has taken office, and particularly for the last 10 days. I mean, that in itself has been somewhat mystifying. And you've served there in government, in the United States government, as part of the US TR. And so please help us understand what's your take on some of the recent moves, and also the use of tariffs as an economic instrument by the United States.
Well, thank you so much. It's really my pleasure to join this discussion. Loaded question, but just let me try and be as brief as possible. Like we all expected tariffs to be on the president's agenda. But I think what has surprised everyone is the speed at which he's been imposing these tariffs, the scope, both product and country scope of the tariffs, and frankly, the severity and the high rates he's been assigning countries. And so when I talk to a lot of our foreign trading partners, they just feel like a tsunami is hitting them, that it's hard to keep track of the different tariffs, and they're being hit in ways that they think are unfair. Now, that said, the administration this week introduced a 90-day pause on some of the tariffs to allow for negotiations with countries. And I think that was a welcome development. However, we should keep in mind that there's still a lot of tariffs in place, including a universal 10% tariff against all countries, all products. We have unprecedented rates above 100% now with China, and China just overnight hiked its tariff even higher, where I think we're in a situation where we're not going to see any trade between the United States and China until we find a way to get back to the negotiating table. And there are also sectoral tariffs in place with respect to steel, aluminum, and autos, and more sectoral tariffs expected. So, for our viewers, even though there has been a bit of a respite, we're still in a world where the tariffs are high, the markets are responding, businesses are facing a lot of uncertainty, consumers are going to see higher prices, and this is going to reverberate all across the global economy, including in India. Although, let me just stop here and say, unlike other countries, many other countries, I think India may be one of the prime beneficiaries of this policy, particularly as U.S. companies feel that they can no longer do business in China. Back to you.
Wendy, before I move on, what do you make of tariffs that have been imposed on countries which, with the United States, say have zero tariffs? Or I read somewhere today that, for instance, Ivory Coast actually exports cocoa to the United States. 76% or 75% of the exports out of Ivory Coast is cocoa. And so it's really hard for that to be onshored onto the United States. So broad-based tariffs, which have also gone on beyond China and India to some of the smaller countries, like Ivory Coast in this case, but also economically stressed countries, say like Sri Lanka or Pakistan in our neighborhood. How would you interpret that decision and the kind of ramifications that may have?
So my sense is that in internal discussions at very senior levels in the White House with cabinet officials, there was a lot of back and forth about how to implement Trump's tariff policy. And I think what probably happened was that things got so complicated that the team then gravitated toward a very simple formula. But this formula that they agreed to applied to all countries, no exceptions, no recognition whether a country where they were in the in terms of development, no respect for free trade agreement partners. They were treated the same as everyone. And the most ironic thing for me is the formula didn't even include tariff differentials. It was all about trade deficits. And so in some ways, calling this a reciprocal tariff is a bit of a misnomer because, frankly, these tariffs have all to do with the level of the trade deficit with individual countries.
And Wendy, I think China's just made a statement, but something that probably has not come out in the media as often as we would like is that there is a services trade surplus that the United States has with China. Probably of, I think it's the total surplus is about $40 or $50 billion. So it's not the same scale as goods, but nonetheless, that there is a services trade surplus. And of course, China wants to make that point. So let me circle back with you, Wendy. I want to ask Surjit. Of course, we are here in India. We are trying to evaluate what this would all mean for us. And Wendy says there might be a window of opportunity for us. I think in India, would you say that we are cautiously optimistic, or what is it that we need to do? How do you see it, and what needs fixing here so we can actually take advantage of the situation?
Thank you. I think it's a tremendous opportunity for India, and I'll go into some details in a minute or two. But I want to first state, you pointed out about the services trade surplus that China has pointed out that U.S. has. Now, very interestingly, all of us, let me just include all of us, have argued for tariff reform and trade reform in India. And India has a very nice services trade surplus. So therefore, I thought it was very reminiscent of Indian argument. So any Indian who makes the argument that our tariffs are too high, which I think all of us do, will have to come to terms with as to the Chinese argument, which I don't think has any weight whatsoever. Second, and related to the first point, I don't think that the Trump policy has anything to do with tariffs. And I don't think the stated tariffs, have any economic logic to them, as Wendy also indicated. And so what to do? And I think that came out a couple of days ago when Trump announced a 10% blanket tariff and all. And 10% is, in my view, no story. So for most of the countries. But what he did say is that apart from the 10%, that China would not have a 10%, would have a steep tariff. And as Wendy just mentioned, that steep tariff in China and versus China tariff has gone up to 100% or something. So whatever number we take, it basically means no trade. So that is, now how it pans out, we don't know. But basically, this has been a feature of the US policy for now a decade. It was Trump who first came out with the policy of anti-China mercantilist policy, that look, they were targeting China. Then Biden came, and we all thought that Biden would get away from the policy of Trump vis-a-vis China. And it turned out that Biden doubled down on what Trump has done. And now Trump has tripled, if you will, by his policy. So this is US-China trade war, US-China adjusting. And I would give the reference, a very, very good book by Rush Doshi called The Long Game. And Rush Doshi was the National Security Council director for China and for the Biden administration. And in The Long Game, what Rush Doshi tried, and this was written, I think, 2018 or thereabouts, much before now, that look, China's game plan, and that's a long-term game plan, is to displace the US as the hegemon, economic hegemon, certainly, and perhaps even the political hegemon. And that is what their policies of what I would call a form of mercantilism was and is. So I think that's the big picture in my view. Now coming to India, that, look, there is, what is that line? There's many a man, and these days we'll say many a woman found 6 feet under because she bet on India doing the right thing. And we in India have argued, and I don't know any exception to this rule, that we have a very controlled economy vis-a-vis trade and investment. And that is what, and we are very comfortable. So why do we have still going on for 30 years, this policy? And it's become a bit worse over the last decade. Broadly, it's the same story. So why have we done this? And I think we, Indian governments, BJP, or Congress, or the Third Front, whatever, are very comfortable with a growth rate, GDP growth rate of somewhere around 6.5%. So there have been no incentives to change. There's a risk if you bring out change of a fundamental nature. And we know that from the Congress's defeat in 1996, they introduced reforms. In 1991, Indian growth rate accelerated from something like 5 to something 4.5 to something like 6.5, 7, and they got defeated in 1996. So Indian governments have been very conservative and very comfortable. And I think the deep state in India is also very comfortable without any reforms, because that will hurt their profits. So I think what Trump, now to conclude, that what Trump has offered and made possible in a global context, that is really forcing India to change. And it just got announced a few hours ago that we are on a 90-day fast track for reforms. That the first stage of US and India treaty has been agreed upon, or the terms of reference have been agreed upon. So I think I am very optimistic as to what will happen. We will have a very good forward-looking, because there's Trump and the US and the whole world is watching. The whole world is literally watching. So we'll have a US FTA treaty, and after that, there is a treaty with the UK and with the EU. So those are three big major trading partners. And I think the US-India BTA, or whatever it's called, will be a model for the rest of the treaties. So that is how I come to the conclusion that this is that India might be the best placed amongst all the countries. One, on the tariffs, that the tariffs are lower, but secondly, that we would be able or have an opportunity, a Trump-sent opportunity, I call it, to really bring about major reforms. So a 99 moment again, I hope. And in a way, I'm forecasting that over the next 6 months, India will have its second 1991 moment.
You clearly seem to agree with Wendy that India might be at least better placed than some of the other countries to take advantage of the opportunity. Your point is clear that the moment is not just that it is here. It should have been in the making for at least a decade, if not more. You were part of the high-level committee on trade and certain recommendations. If it is this moment, and what would be the one or two areas that we could start with? I was looking at agriculture is usually mentioned as like one of the areas. And then I was looking at the agriculture import and exports for India. Like 40% of our exports in agriculture is shrimp, and like 50% of import is cotton. So it's so skewed by one or two products. But yes, there are some outliers where we have tariffs of over 70, 80%, but that seems to be in specific areas. What would be the one or two areas that we could start with that could please the US administration, would be good for India, and good for our citizens?
Yeah, you're absolutely right to single out agriculture. Now I'm going out on a limb, okay? As you know, the Modi government tried to bring about agricultural reforms, farm laws in 2022, and the political opposition was such, that it fell flat. I think, with even the HANA and others getting into the act. So it was a very unfortunate moment, in my view, that we didn't institute those reforms. I think apart from the industrial, foreign trade, foreign investment reforms, which I think will first, it is, if I were to go out on a limb, there might be a process set in place that we have a reform of agriculture, wheat, rice. We are big producers of wheat and rice, and we have lots of controls, the PDS and all the policies. So I think this is an opportunity for us, for the farmers to benefit, for the poor to benefit, and for the country to benefit. That's the larger picture. Now, let me just add on my own, if you will, I think the possibility, there is not much, in my view, there is not much of a political opposition to the Modi government. And therefore, I don't know another moment like this in Indian history for some substantive reforms. starting with industry and tariffs and what we are talking about. But I think the larger, but I'm going out on a limb, I understand that, but I think the dominoes are in place.
Well, we have 90 days and we will know if some of our hypotheses will hold. Neelkanth, thank you for waiting patiently. I suppose we're also trying to make sense of the effect some of these announcements have had on global financial markets and also India's financial markets. And then, of course, how that has implications for Indian consumers here. So can you help us make sense of what has transpired in the world as a response, and then how Indian markets have responded?
Yeah, no, thank you for having me. I think a wonderful discussion and a very important topic. Let's divide the markets into three parts: equities, currency, and bonds/rates. Now, equities, because they discount very long-term cash flows, they are the most vulnerable to uncertainty. So the first response, obviously, was an incredibly steep correction in the equity markets globally, much more in the US because the uncertainty is the greatest there. This is what we would call in financial parlance the rise in the equity risk premium, which is that if you're buying a risky asset class, which is equities, you should demand better returns. Now, the challenge, of course, is that the markets are also used to the Fed put. So in the last 30 years, especially after Greenspan, every time we've seen kerfuffle, the Fed has come and cut rates or done a lot of bond buying, done a lot of QE, and somehow supported the financial markets. I think the difference this time is that the Fed put may not be very effective. So even if the Fed was to come in and start buying bonds, of course, it may be able to push down yields, but it'll create more uncertainty, more future inflation, and therefore more risk to equities. So the ERP has gone up. So equity markets have corrected. That first phase of correction seems to be over, meaning that there is a downward reset, and clearly no one knows. I don't think even the administration knows what it's doing. And I think we are starting to get clarity on the broad objectives that they're worried about the rising inequality. At least that's what they're talking about. They're worried about that the new Triffin dilemma, that the Triffin dilemma was addressed by the US breaking the gold peg, but the new Triffin dilemma is that the US must incur a current account deficit if it has to remain reserve currency, and over a period of time, it will accumulate so much of net international liabilities that it starts to become unviable. So it's a time, at some point we would have faced this. The net international investment position of the US is now minus $18 trillion, minus 60% of GDP. Whether minus 60 is enough or we have waited for minus 70 is a very different debate. But the point is that these questions have been asked, and I think at some point this needs to be debated, and therefore I think a reset of the monetary system, or let's say new terms of engagement need to be established. There is also an additional uncertainty of the fact that the US has accepted that the multilateral world order it had helped create in 1945 is no longer working, and it's going to have bilateral agreements, which means a significant rise in uncertainty. So currently, the bandwidth of the US trade representative is the biggest, I would say, bottleneck for the equity markets to get certainty on what really is going to happen. So who met the president first? Who called the president? And so Japan, for example, jumps ahead in the queue because the PM called President Trump. So those kind of things, and therefore it just adds to uncertainty. And therefore, I think the ERPs have a lot more room to fall or to rise, meaning the PE multiples have to fall. So that's where we are. At this stage, it's very hard to estimate any impact on earnings directly. What we can say is that there is a negative 1.5% at least impact on global GDP. So the Trump tariffs themselves on 2nd April were about $550 billion. After the revisions, they are $600 billion because China is at 125%. So that's a massive fiscal contraction. The US will try to pay it back through tax cuts, but that will be saved, not spent. So that's a 0.5%. And if you think that about 8 to 10% of the world GDP is corporate capex, and if 10-12% of that gets postponed by a year, waiting for clarity on tariffs, that's a 1% of global GDP, which is now waiting. And that itself means together about 1.5%, which is close to half of the forecast growth rate for this year. So there is significant growth uncertainty, but markets can therefore fall a lot more. As of now, they're just waiting and watching as to what happens next. The second market to get impacted was the currency market. In the currency markets, things don't move by 10, 15, 20% very quickly. If you go back and look at what happened after the Smoot-Hawley tariffs of 1930s, the currencies moved by 50 to 250% against gold. So in Japan, Britain were the first to break the gold peg. Then America broke it. And then 2-3 years later, France broke it. The countries that broke the peg to gold basically devalued their currency, like Japan, saw industrial production rise continuously throughout the decade. Britain was the next best. It broke it immediately after Japan. And France, which broke it the last, saw IP, industrial output, fall throughout the decade. So the temptation, and especially if there is no multilateral world order, export incentives, currency devaluation, all of them are, so long as you are kind of protecting a peg to the US so that they don't go after you. And frankly, after a while, I think the US will also get tired of signing so many transactions, monitoring so many things, because it will come at a huge headache. But this is uncertainty, again, that the equity markets need to grapple with and the currency markets need to grapple with. As of now, the biggest stress point is the Chinese RMB, and maybe we can discuss later. But even before this, they had a stressed balance of payments position. It's not just about the current account. They need to do a lot of outbound FDI. Their interest rates are low, so a lot of trade credit is flowing out. And that means that the balance of payments, despite $1 trillion goods trade surplus, was under stress. If that trade shrinks by $300-400 billion, which it can with this kind of duties, they have a significant problem on their hands. And therefore, they are slowing down the pace of depreciation or devaluation because this will be seen as an act of war, an act of trade war. And therefore, it is in their interest to slow it down, because otherwise then things go out of hand. That in its turn has created another problem, which is in the bond markets. So normally you would expect that the bond markets in the US Treasury yield should fall, bond markets go up in price, because as uncertainty rises, people shed risky assets like equities, and then they start buying safer assets like bonds. Instead, the 10-year bond yields in the US have risen. Now, the reason why, there are many people who think that, Chinese are dumping treasuries and therefore pushing pressure on the US. I don't think they're that dumb, because frankly, if that is the tool they use, the Fed can come and buy $500 billion and that'll end the story. So it is too expensive to be taking that route to actually hurt the US. I think what they've been forced to do is sell US treasuries to protect the RMB from falling a lot. In the process, they have disturbed what is actually a very delicate basis trade. So hedge funds in the US, because after the Volcker rule was implemented, after 2008-9, the large banks moved out of providing liquidity in the bond markets. So what happened was hedge funds stepped in. The hedge funds buy bonds and sell futures. And the futures are on the same underlying, so there is no risk really. There is a marginal spread because of the different liquidity and demand-supply position. So that spread is very narrow, and generally it is reasonably stable. So what they do is they will buy bonds and sell futures. So they have no net exposure. And the banks, because the underlying is the US Treasury, are willing to give them leverage. They lever up sometimes 60 to 100 times, and because to make sufficient returns, because the spreads are very thin. The problem is, if the bonds move very fast, don't, because clearly not meaningful shift in US Treasury's prospects. the reason why yields moved up a bit was some central banks like in Vietnam or China were sell in the US treasuries. That disturbs that spread, and suddenly that 100 times levered spread has to be unwound. And this is happening at a time when global banks would have been told by the risk managers. So they're telling the hedge funds, dude, just return it. Now they are forced to sell the US treasuries to cut down on that leverage, and that triggers a downward spiral. And that is what has actually pushed up 10-year bond yields. So despite the 90-day suspension, 10-year bond yields are still at 4.45, 4.48 the last I saw. Now, the currently, there doesn't seem to be a panic. It still, to me, seems to be fairly orderly. But this, if you read some of the press, and I do believe, I think that is true as well, this is what caused the 90-day suspension. Because when the bond market goes out of whack, which is what was starting to happen, you are talking about a collapse of the financial system. And this would have been the first time that the collapse of the financial system could have been blamed on one person. And so this is, in a way, the reflexivity theory that the bond markets. So remember that the Overton window for any leader is a very narrow one. In this case, because the president thinks he has a mandate to really disrupt because the old world order was not working, clearly a lot of inequality in the US and a lot of other social and political problems. So he thought that, and he thinks that the Overton window is very wide. He can do what he wants. I think this was one signal that the markets may not be ready for that level of disruption. And sometimes the market disruption will narrow the Overton window, the range of policy options that you really have. So this is, I think, has already happened. And so we have seen the president pulling back. The next leg or the next legs in all of these three markets would continue to be quite disruptive. Remember that the growth shock surprise has still not been priced in. The vulnerability of the US Treasury market. So what has happened, again, on the currency side, is that normally you would expect the dollar to appreciate when there is a problem. So in fact, as one blogger wrote very funnily that even when the US debt was downgraded, the US dollar appreciated, because when people want to play the safety trade, they actually go to US assets. What has happened this time is that the DXY is now had gone below 100, partly because someone is unwinding the yen carry trade, and therefore the yen is appreciated. The Europeans, because they themselves are doing fiscal expansion, bond yields have gone up. So on a hedged basis, even at 4.45% rate, the Europeans would find it more remunerative in euro terms to be buying the bund. So because there's a hedging cost now, and the more volatile this is, the higher the hedging cost, and therefore the nearly 30% of US treasuries that are owned by foreigners is at severe risk. So this is nothing about the US dollar as a safe haven or reserve currency. I mean, those are very long-term issues, and we shouldn't get there. But in the near term, I think all of these are factors which will affect policy. So the Trump administration does want the dollar to depreciate. The fear everyone had, and I think they should still have, is that if the tariffs increase inflation, they will push up yields and therefore push up the dollar. In the near term, though, exactly the reverse is happening. So there are some very interesting things happening. The more disturbed the market is, the less flexibility I think the US administration will have. I'll stop there.
So Neelkanth, connect your assessment of global markets to the implications for India and what Surjit has said, that there is an opportunity here. If there is this kind of disturbance in all three markets, equity and bond and fixed income market, and from Wendy and Surjit's perspective, perhaps as far as trade is concerned, which is a slightly more long-term, from a policy's perspective, is usually a more long-term game rather than markets. They definitely see an opportunity for India to reform. And, Wendy's also authored a paper where she's spoken about the benefits this could have on countries that actually open up their economies, including India. So is this the right opportunity? Will the market support this kind of move?
100%. So the fact that India had, I think, 118% import duty on sausages because apparently some business landed up in Delhi and he said, I can make it myself. And apparently the official in charge immediately slapped 118% duty on sausages. That kind of idiocy will get unwound. So at least someone will be paying attention to what we are really doing with our duties. And even if there is lobbying, I think there is enough political cover, because I think there is enough conviction in the government to make, because, the more open we are, the more competitive we are. In certain strategic sectors, maybe there is some protection needed, but by and large, I think bringing down duties is beneficial. But I think there is a much bigger story here. Remember that if the Vietnamese, China, as Surjit rightly said, I think 125% basically means that you don't want any trade to happen. So a lot of the stuff like, say, electronics assembly, apparel, footwear, apparently footwear industry in China starting November has seen a 70% drop in orders because the buyers are clearly aware that they don't want to be breaching contracts. So there is a big opportunity for us to actually create the space to absorb that flow. Normally, it would have gone to a Bangladesh or a Vietnam, but if the Trump administration's objective is zero deficits, there is absolutely no way that Vietnam can offer to buy anything about $130 billion. I mean, the GDP is $450-500 billion. So that there's nothing they can do. What they will be forced, and they're also vulnerable to the charge of currency manipulation. Remember, the USD VND has been shockingly stable for a very long time. So I think they will be forced to appreciate their currency. They can be. There may be some other military or whatever demands made. But the opportunity for us is in pulling a lot of electronics assembly, footwear, apparel. These are where there's ready capacity. Okay. And I think that last point on the financial markets, given that the current government has been so remarkably disciplined on the fiscal front, and the supply of bonds is actually flat to down, the Indian government bonds, and given that the currency is no longer under pressure, are among the most safe and most, I would say, even rewarding currencies, rewarding assets anywhere in the world. And remember that the fully accessible root bonds are now freely accessible to foreign investors. You don't really have to stick to the benchmark. It's just been a week, but it is starting to emerge that the emerging market bond funds are now starting to see inflow. So it is quite possible that the Indian bonds, we're already at 6.4, no would have yield. We would have never thought that we would get there so quickly. So I think there are some very interesting market moves that can be supportive for India as well.
So Wendy, perhaps we will come and close with you. Music to your ears, what Surjit and Neelkanth are saying, which is an opportunity for reform. Markets are there to support us. And there is an opportunity specifically because India probably has a large enough market, both financial market but consumer market, to actually take on what Vietnam and others cannot.
Look, again, I think there is a tremendous opportunity. I couldn't agree more with the previous speakers. But I also just want to introduce kind of a note of caution, and that is trade negotiations between the U.S. and India have always been challenging. And I recall during Trump's first term, then USTR Lighthizer was spending time with India and wanted very much to conclude a so-called mini trade deal. And he was unsuccessful. He kind of threw his hands up and, couldn't conclude this. So I don't think it's a given that the U.S. and India are going to reach some type of agreement, not only within the 90 days. My understanding is the real deadline is probably President Trump's visit to India with other Quad leaders in September. At least that's what we're hearing. So, I think the burden I do remember the Prime Minister Modi's efforts to reform the agriculture market, and he was met with so much domestic resistance. So again, I think, there are opportunities. And again, I think India is well positioned in that if you look at kind of other countries India is competing with to attract U.S. investment, Vietnam really has a target on their back right now with a growing and huge trade deficit, but also a lot of Chinese investment. And that is of great concern to this administration. So in any negotiation with Vietnam, I'm sure the U.S. is going to press to be less welcoming to Chinese investment, or that Chinese exports, don't benefit from just locating in Vietnam without sufficient investment. Mexico too has a number of challenges as well, including the tariffs that were initially imposed against Mexico for its migration and drug interdiction policies. Again, India well positioned, and I want to leave this webinar in a very kind of upbeat way, but the road is likely to be rocky going forward, and I think that it's going to be incumbent on India to come to the table with some big reforms and a real commitment to open their market.
Well, Wendy, I think your point is very well taken. I think it resonates here, at least with these two panelists. And the interconnection between trade, economics, and financial markets is also increasingly apparent. So while trade negotiations are taking place and they seem to be rather focused on tariffs, tariff lines, and non-tariff barriers, but clearly the implications are larger, both on countries as well as on different markets, consumer and financial markets. So we will have a chance to revisit in 90 days or by September if what we discussed today stands the test of time. We are out of time today, but I would like to thank you all for joining this discussion. Wendy, we hope to see more analysis on trade, and you lead the Asia Society Policy Institute's work on trade and on international trade and economic security. So with that plug for Asia Society, I also want to thank you, Surjit and Neelkanth, for joining this conversation. The hope that you will come back maybe in September and we can revisit this conversation and see how we fared. So thank you again.
Look forward to that. Thank you.
Thank you.